On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, the largest in U.S. history. The next week, on September 22, 2008, a $1.366 billion plan for Barclays to acquire the core business of Lehman Brothers was approved. Manhattan Court bankruptcy judge James Peck, after a 7-hour hearing, ruled, "I have to approve this transaction because it is the only available transaction." Lehman Brothers became a victim. In effect, the only true icon to fall in a tsunami that has befallen the credit markets. This is the most momentous bankruptcy hearing I've ever sat through. It can never be deemed precedent for future cases. It's hard for me to imagine a similar emergency. What led to this collapse? How did this happen? Welcome to my 3-part series on Lehman Brothers. Part 1, the beginning of the end. In this video, we're going to talk about the basics of investment banking, the history of Lehman Brothers, and set up the events preceding the collapse of the firm. But first, what is an investment bank? An investment bank is a specialized financial institution that acts as an intermediary for complex financial transactions. Some examples are Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Deutsche Bank. These institutions offer a variety of services, targeted mostly towards institutional clients, rather than individual consumers. Their services extend beyond initial public offerings and mergers to include other core services. Some of these core services include underwriting, which is when investment banks will underwrite new debt and equity securities for different types of corporations. For example, if a company wants to offer a type of bond off to investors, it would advise the assistance of an investment bank. The investment bank would help underwrite the debt and come up with a price and packaging of that bond to sell towards investors. They also provide strategic advisory services for mergers, acquisitions, and other financial transactions. This can include comprehensive financial analysis, valuation services, and negotiating assistance to help their clients achieve the best possible outcomes. Many investment banks also offer asset management services. They offer these services to institutional investors, high net worth individuals, and pension funds, and they manage a portfolio of investments to achieve a specified investment objectives. Apart from advisory and underwriting, investment banks also involve in market making and trading of securities. They can buy and sell financial instruments such as stocks, bonds, and derivatives to facilitate liquidity in the financial markets. This is the section that precipitated the collapse of the firm, particularly in its dealings with real estate and mortgage-backed securities. In summary, investment banks offer a variety of services for institutional clients that are complicated or difficult for other types of firms to carry out. The 1920s, or the Roaring Twenties, was a period of sustained economic growth. Over the period of 10 years, there was a substantial bull market which increased prices. As people began to see that the stock prices were going up further and further, people began to put more money in it. And this included everyday people, it included commercial banks, it included all sorts of firms. People were taking as much money as they could and putting it in the market. And you have to remember, at this time, there was relatively low financial literacy because they couldn't find enough money to invest as they started borrowing money to invest. Now, the problem with this is when you borrow money to invest, you can make a lot of money. Let's say you want to buy $10 worth of shares. You can borrow $7 and only use $3 of your own money. And if that stock goes to $20, you've now made $13 and only have to pay $7 back. So that $3 that turned into $13, that's nearly a 4 times return on only a doubling of the stock. This was really attractive to a lot of people because the stocks, like I said, were only going up and up. If the stock price goes in the other way, you could lose money too. So that same $10 of stock, if the stock price halves and goes to $5, you now owe $7, but if you sold the stock, you'd only get $5 back. This completely wipes out your position. This is why using leverage can be extremely risky. It can amplify returns, but it also amplifies risk. Because of the risky practices that led to this financial crisis and later the Great Depression, Congress enacted the Glass-Steagall Act of 1933. This act provided a variety of provisions to safeguard this from ever happening again. One of these provisions, which you may be familiar with, is the Federal Deposit Insurance Corporation, or FDIC. Whenever you put your money in a bank, you may see that it is FDIC insured. This means that if the bank were to go bust, your financial deposits will be secured up to $250,000. Another important aspect of the Glass-Steagall Act was the separation of commercial and investment banks. We already talked about investment banks, but commercial banks are your normal banks with savings. The problem that occurred in the 1929 financial crisis was that commercial banks were using consumers' deposits to fund risky investments in the stock market. When the stock market dropped, their holdings were wiped out and they were not able to pay the people who held deposits in the bank. After the enactment of the Glass-Steagall Act of 1933, the United States entered a period of sustained growth in the economy. Some argued this was mostly due to the post-war period, which was more of a function of demographics more than anything else. But others say that Glass-Steagall allowed for less volatility in the capital markets, which allowed the economy to grow at a steady rate. Now let's talk about Lehman Brothers. Some interesting things about Lehman that I learned while making this video was how involved they were with the history of slavery. In the 1850s, Lehman was involved in the cotton trading business. Pre-Civil War, most cotton was produced by slaves, especially in Alabama where they were located. Over 45% of all cotton produced in Alabama was by slave labor. They eventually moved their headquarters up to New York City, but some other firms that they invested in also have interesting histories as well. For example, in the early 80s and 90s, Lehman began investing more heavily in oil companies. Some of the oil companies that they invested in were Halliburton, known for its involvement with Dick Cheney in the wars in the Middle East. And you kind of go through the history, Lehman Brothers is in a lot of places where you wouldn't necessarily expect it to be. A lot of the IPOs that they did were for companies that are still around today, such as Macy's, such as Sears, Studebaker. So all throughout America's financial history, when researching this video, I saw Lehman Brothers' name pop up again and again. They were acquired by American Express, and they were spun off in 1994. Dick Fuld became CEO, and he helped navigate the firm through the 1997 Asian financial crisis, which involved long-term capital management's collapse. It nearly precipitated the collapse of the entire U.S. economy and could have taken Lehman Brothers down with it. Just like the 1920s, the early 2000s were a period of sustained economic growth. Just as people thought that stocks couldn't go down in the 20s, people also believed that real estate couldn't go down. More and more companies were using the booming real estate market to make money. And different financial instruments were created, especially after the repeal of the Glass-Steagall Act in the Clinton administration. Lehman acquired mortgage businesses such as Aurora and BNC. These specialized in subprime loan origination. Some of these loans, for example, didn't require income, didn't require job verification, didn't require assets. They were known as ninja loans. No income, no job, no assets. This sounds pretty ridiculous saying it out loud today, but writing loans to people without verification of a job, income, or assets isn't particularly best practices for guaranteeing that loan. However, because real estate kept going up and up, people didn't think that it mattered that you were writing loans to risky people. If you were to write a loan for a house for $500,000 and you lent $400,000 to that person, if they defaulted on the loan, well, now the home could be worth $600,000. So they could simply sell off the home to somebody else to pay off the mortgage. People believed, unreasonably so, that just because prices had gone up means that they would continue to go up forever. And Lehman Brothers was one of the worst firms that was involved in these practices. Lehman was raking in profits and increased its positions more and more by leveraging its position. By 2006, Aurora and BNC were lending almost $50 billion per month. From an asset standpoint, Lehman Brothers was becoming more of a real estate hedge fund than an investment bank. The leaders of the firm didn't know it yet, but this would be Lehman's ultimate downfall. This strategy would ultimately be the beginning of the end. All right, guys, that's all for this video. Join me again next week when we talk about the mechanics of mortgage-backed securities and go into specific details about the financials of Lehman Brothers and show how it collapsed. See you then.